So now that we understand the purpose of a cash flow management system, we need to implement the principles that are going to allow us to accomplish that purpose. The very first, sub-purpose or sub-method of gaining control of each dollar as it comes in is to only allow the money and the dollars that are dedicated for giving, living, and debt repayment to ever even enter into the main operating account that you use, or the main operating accounts that you use for cash flow management. And that's really a paradigm change, because most of the time all of the income that comes into the household goes into the same account or accounts that all of the bills and expenses are paid out of. That's the normal way of doing things. But what we're going to see is we want to structure a cash flow management system to sidestep, or in another way we could say we want to add one extra step to the direction of the cash flow. And so what we're going to look at is, instead of distributing the income first to the different short-term purposes of money and then trying to divert a certain amount into investments and or savings, what we're actually going to do is we're going to actually divert all of the income from all of the sources into what we'll consider to be the investments or savings bucket. That will be the very first step. So the restructuring of your account and accounts basically begins with the step that all income from whatever source, whether it's work, whether it's income tax refunds, whether it's overtime, whether it's extra checks, however you're paid, that would first go into an account where you want to catch your investments and or savings. After all of the inflow has gone into the account where you want to capture the savings, then a certain amount can be distributed each month into the main operating accounts for the purposes of giving, living, and debt repayment. And so what's the advantage of doing that in terms of changing the order? Well, the philosophy of making every single dollar by default be investments or savings has a couple of positive attributes and results. One is that the capturing of savings, or the capturing of cash flow margin, ends up being automatic. In other words, you have to assign a certain amount per month for giving, living, and debt repayment. Otherwise, it's going to be saved. So instead of trying to divert money into savings, it by default saves the money. Now, if more income than anticipated comes in to that account, there's no need to change anything because it's going to automatically be saved. If less income comes in than anticipated in a certain month, what we're going to find in the future is that that will actually allow us to have a regular cash flow to be distributed out of that, what we're going to call the margin account. That's where the cash flow margin comes in. A second advantage to setting your cash flow process up this way relates to income taxes. Now, very few people have their income tax withholdings set up to automatically take out the exact right amount of income tax liability. That results in either an income tax refund each year or owing income taxes. Now, if all income goes into an account that's the savings, so to speak, and only the amount is distributed for giving, living, and debt repayment, what you have is, if too much money is being withheld from your income, what occurs is an income tax refund over time. Now, if all inflow, including income tax refunds, are deposited into the account earmarked for savings and investments, then that cash flow margin that results from that incorrect tax withholding ends up in the investments and savings account. And that is ultimately what we want. Now, in a case in which not enough money is being withheld from paychecks, that results in a deficit. That results in a situation where we owe the IRS money. And in that case, sometimes that creates a real hardship if that money hasn't been being set aside. But what happens is, if not enough money is being withdrawn out of income, then the extra amount that's coming in is going into the savings and investments account throughout the year. And so money that we don't necessarily deserve is going into that account, but it's not leaving the account because we've established a certain fixed amount each month for giving, living, and debt repayment. So at the end of the year when we file our taxes, if we do have a deficit, if we have an owing amount, then that is already captured and saved in the investment savings account.